Welcome back. For those of you who don't remember me or didn't have me, Bob Hansen. Teach managerial economics with this guy, Professor Bauer, and we will not let him get the chalk this morning, okay, whatever we do. But in these rooms, we don't have chalk anymore, so we're safe. He doesn't know what to do. Welcome back. It was a year ago at the reunions, one year ago when we were really standing on the edge of what looked like the abyss, as I say, and not knowing at all what was in front of us. We convened a panel like this for reunions 1 year ago, and it was an immensely successful event, and we had several of them throughout the year as well, some of which maybe you saw because we broadcast them on the web. So we thought we'd do a similar event this year. I've got an extremely illustrious panel, 3 alumni and one professor. They're going to introduce themselves a bit more. I'm going to give a brief introduction of them, and then they're going to give their views on what happened, where we are, and where we're going. And you'll see that we've got a nice representation of people. So Sue Allen is Tuck 89. She founded a company called Murray Hill in 1997 that was focused on the mortgage industry, did analytics and risk management. It was merged with Clayton Holdings in 2005, at which point Sue retired as CEO. She started another company now, Allon Hill, which is, again, in risk management and due diligence in the mortgage industry. So Sue, welcome back. My colleague, John Lewellen, is Associate Professor in the Finance Group at the Tuck School. He's got a PhD from the University of Rochester. We lured him away from MIT in 2005, and he's been here ever since. He teaches the capital markets course starting tomorrow morning. He'll be teaching capital markets again. We have this new schedule at Tuck, so poor John's got to start tomorrow morning. But this was good work to get ready for class tomorrow morning as well. John knows the data probably better than almost anybody else in terms of stock returns and other kinds of asset prices as well. He knows that data, he knows the patterns, he knows the theory of them as well. So that's great to have him on board. David Morse is a Tuck 89. I should have said Sue's on the MBA advisory board, as is Dave on the advisory board as well. Dave is a managing director of Neuberger Berman. He's also portfolio manager there. Neuberger Berman, of course, how should I say, emerged out of Lehman Brothers? Escaped out of Lehman Brothers. David worked in GE Capital's corporate finance business, and he was the founding partner of Hampshire Equity Partners before he joined Lehman in 2003. And you'll see that David's going to give us a view of credit markets as well, probably building upon what John does. Last, we have Alec Reuynal, who's a Tuck 69. He's been on the Tuck Board of Overseers. He's the founder and currently chairman and CEO of MBA Lazard, a leading investment bank and asset manager focused on Latin America. And Alec's had an illustrious career in investment banking in Argentina, but not just in commercial investment banking. He served as vice chair of the Central Bank of Argentina and Minister of Economy of the province of Corrientes as well. So, and Alec, I've asked to have him give us a little bit of a view from Latin America, standing on the sidelines, so to speak, watching the craziness that goes on in this country. So welcome to all of you. Thank you very much for getting up on Sunday morning. Thank you for all of you. I'll let each one of them present for 10 to 15 minutes. We don't have a hard break at 11 o'clock. If any of you have to leave, of course, we understand. But we'll have some time for Q&A afterwards as well, I'm sure. So Sue, why don't you kick it off?
I'm happy to start. I want to stay and take this capital markets class tomorrow. How about everybody? I'm sure they can fit us in. So I have a company called Allon Hill now, which actually competes with the company that I sold, which is kind of an interesting thing. But we do manage risk on mortgage-backed securities, and we do due diligence on mortgages that are being securitized. And the fact is, over the last 12 months, we haven't done much. There haven't been a lot of mortgages, and there haven't been any securitizations. But we are seeing securitizations beginning to form right now. The street firms are all putting securitizations together. We're hearing predictions of 6 months from now from some firms. Other firms think it'll be more like 3 months. I think the race is on, and I think these guys are highly competitive, and that we will see securitizations of newly originated mortgages within about 3 months. But before we talk about that and what that means to the economy, I want to give you just my sort of sweeping view of what happened since the mortgage sector was, after all, the first to fall, and theoretically the sector that took us all down. Leading up to 06, 07, mortgages were a pie-eating contest. Everybody was just trying to see what they could get, and more was better. I was on the board of a company whose benchmark went from what was our quality, in other words, how many loans were rejected from the pools we reviewed. It went from that to what was our fulfillment rate. How many deals were we able to accept, and how many did we have to turn down because we couldn't staff them? That's a bad sign for quality. People during this period leading up to 06, 07 weren't buying homes, they were buying mortgage payments. They were trying to see how much loan they could get. There was a frenzy among Americans to see if they could get a bigger home. There were people living paycheck to paycheck who were trying to, who would get caught up periodically by taking out a new loan, a refinance mortgage, taking cash out of the equity in their homes so that they could catch up on their credit card payments and put a down payment on a new SUV. Originators helped with that. They contributed. They told borrowers how to lie. They covered up for them. They cheated where they could. There was no QC going on these mortgages because there was just too much volume to keep up with them. So even well-intended originators couldn't look at enough loans to catch all the flaws and all the fraud going through. The high yields that we saw on mortgages attracted uninformed investors, and I think that that was a contributor to the downfall. Everybody started buying these things, even people who really didn't understand mortgage product. I think that some investors bought this product knowing that it included a lot of problems, and they got over it because it wasn't disclosed to them in writing, and so they didn't really have to disclose it up front to their investment committees. I think other people possibly just didn't understand the risk but knew it was there. That frenzy, though, drove the price up for these loans, which were getting worse and worse in quality, but were not defaulting yet because, again, people could go out and get another loan to get themselves current. CDOs and derivatives added fuel to the flames. Off-balance sheet accounting meant that some institutions got to invest in this product when they really had no business investing in this product. In 06, we began to see the first rumblings, the first indications that people were worried that mortgagors in the United States would not be able to continue to make their payments. And it really was that, I think. It really did just start with perceptions that maybe this product wasn't as golden as it seemed. It took about a year, and in the summer of 07, the message finally began to get to Wall Street that investors weren't going to continue to buy these things unless Wall Street cleaned them up and stopped putting pure fraud loans, the ninja loans, no income, no job, no asset loans, into securitized pools. It took Wall Street a little while to get the message back to the originators, the likes of Countrywide, and tell them we're not going to buy your product if it continues to have this poor quality. It took a few weeks for Countrywide to tell the borrower, I'm sorry, but I'm unable to lend to you for the first time in a number of years. It then took the borrower a few weeks to get so far behind on his or her other payments that they finally began to let their mortgage payments slip. So now we're talking end of 07, beginning of 08, February of 08, everybody got their Christmas bills and their credit cards, and they fell further behind than ever. They couldn't get a new loan, and they started to default. Bond prices reflected that. In a panic, investors realized these guys are not going to be good for these mortgages. And the value of bonds got marked down dramatically in April. Bear Stearns was the first to fall. The only ones who didn't fall over the last year were the ones who supposedly were too big to fail, not counting Lehman inexplicably in that. Right now, what we're seeing in my sector, we generally look at every transaction in the marketplace involving loans. And that should tell you a couple things. We're a small company in Denver. The first thing that should tell you is there's really not a lot of business if we're able to see every single transaction. There is a tremendous amount of pent-up demand. There really is a lot of money waiting to be invested in mortgages. Investors want to buy distressed mortgages. They want to buy distressed real estate. They would buy new originations if there was new origination. It's fascinating that the FHA is now the lender of choice in America. That's a change from the past few years. We do have money coming in. PPIP, which is much acclaimed, is going to pump only $12 billion into the marketplace. That is not a lot of money. We had TALF, which propped up securitization prices, but they were already so low, it's kind of hard to picture that they could have gone lower with or without TALF money. We have the FDIC very active right now, not selling bank assets. Lots of investors wish they could get their hands on those assets. Those assets are just not coming to market. And we do see a lot of activity in the foreclosure world. We see foreclosure moratoriums, which were intended to keep people in their homes longer. That is it's a false correction to have a moratorium. Keep someone in a home that they can't afford. There's no alternative financing to them, so it's not like they're going to be able to go out and find better financing during that moratorium period. But it has had a good effect on the economy because it's kept this overhang of bad real estate from hitting the market and flooding it and bringing prices down dramatically. We also see modifications. The government's HAMP program, or Making Home Affordable program, is going to push through 1 million loans a year for the next 3 years. That's a tremendous number of loans. Again, I think that's an artificial prop. It's delaying the inevitable for most of these people. The effect of one of these government mods is really not very big. But it does delay the foreclosure. And again, I think that's been good for the economy, and it stopped some really bad things from happening. It stopped prices from just getting run down in an insane manner. And we do see securitizations by year end. They're going to be really, really small. We used to see securitizations of 20 or 30,000 mortgages. The ones we see in a couple months are going to have probably 1,000 mortgages in them. Instead of having 2% of those mortgages reviewed and quality controlled, we will see every single one of those loans quality controlled, reviewed in detail. Instead of seeing no disclosure at all to investors about what they're buying other than in high-level terms, we will see complete disclosure. There will be a CD that every investor gets that has full detail on every mortgage in the pool. That's a big improvement, and it does take away any excuse any investor might have had that they didn't know what they're buying. It's a free country. If they want to buy 100% pool of fraud loans, they can, but now they're going to have to say, we knew that's what we were getting. Concerns about what's going to happen going forward. First of all, I call it Groundhog Day, and what I'm seeing are, even in the modifications program, people willing to lie and cheat the way they did to get subprime loans in the past. I have worked with servicers the last few weeks trying to help them get out from under all these mods. One of the things I've heard was a borrower who called in, was told you don't qualify for a modification because you make too much money, not too little. Borrower's response was, well, how much do I have to make because I can go print another W-2 form? So nothing's changed. There have been headlines about companies that have emerged whose job is to take money from defaulted borrowers to try to get them qualified for these modification programs. There is absolutely nothing an outside company can do. They're just taking money from people who don't have money. And further, I see Wall Street bullying the rating agencies, which is so tempting because the rating agencies are so willing to cave in and not take a stand. So even though we're trying to rewrite the securitization market, I see those same dynamics going on in the marketplace. The market is coming back. The mortgage market is rallying. There's a lot more activity. I'm seeing hundreds of loans every month instead of tens of loans every month changing hands. But my real fear is that it's going to come back in about 6 months, 12 months, and we'll just repeat the same mistakes.
Thank you very much, Sue. I'm trying to figure out where on the spectrum of pessimism and optimism you are. I think a little bit more on the optimistic side.
Optimistic about the market, pessimistic about behavior.
John, you've got slides? Do you have them here? Larry, return to main here.
All right. Well, good morning. Good warm up for capital markets. But I stand up in most classes, so I'm going to stand up. That's the most natural for me. Whoops. Okay. So I'm going to talk a little bit about the credit crisis, and I decided to call it a retrospective, both because I'm going to be showing some graphs of the history over the last couple of years, and in somewhat of a hopeful tone, in the sense that going to take the perspective that the credit crisis has largely passed. Not to say the recession is over necessarily, but that the crisis in the capital markets seems to have largely passed, and I think I'm going to be somewhat optimistic in tone because of that. So let me just show a couple of graphs. This is going to pick up on something Sue mentioned, which is the easiest way to look at what was happening in the financial markets is to focus on the short-term Treasury bill rate. So the short-term interest rate the government pays, and as Sue mentioned, starting in the summer of 2007, so somewhere around July and August, you started seeing a big change in behavior. So there was problems in the mortgage markets. A couple of hedge funds at Bear Stearns had problems, and I forget if they defaulted or exactly what happened, but they started having some problems. And at the same time of August of 2007, there were some other problems with hedge funds. I think one large hedge fund, I forget who it was, had a real problem and had to start selling off lots of assets, and that sort of had repercussions because that triggered a lot of selling by other hedge funds. And so there was a lot of volatility starting in August of 2007, and you can see that it was right at that time when short-term interest rates started to come down and became quite volatile. In the years leading up to that, they'd been sort of this steady march upward without very much volatility. Right at about the same time, you saw lots of problems starting to creep into the different financial markets. So this was the commercial paper market, which was a couple billion, I'll have a slide in a minute, but had a couple $1 trillion of commercial paper outstanding in, I believe it was August of 07. And you can see right around that same time the spread between what a private borrower could borrow short-term at, which is the commercial paper market, and what the US government could, presumably risk-free assets, that spread widened and became quite volatile. That accelerated pretty dramatically in September and October of 2008 when, a year ago when everything really started collapsing. And so you can see it had started in 2007, but then in September and October of last year, it really became pretty dramatic. The drop is nice. I think a lot of that, I don't know exactly how much of it can be attributed to it, but a lot of that is artificial in the sense that the US government backs a lot of that commercial paper at the moment. So the fact that spreads have come way down is really just a reflection of the fact that this is now, much of this commercial paper is backed by the full faith and credit of the US government. But if you just look at spreads, it looks pretty optimistic in the sense that what private borrowers can borrow at for whatever reason, whether it's because of government backing or not, has come way down. Okay? So that's good news. If you look at that behavior, this is the commercial paper market, a little bit more detail around that time. Different types of commercial paper, asset-backed paper, financial companies paper, non-financial companies paper, different grades. You see they basically all were affected to some extent, starting pretty dramatically in September and October, and then started to come down. I believe October 12th or something like that was when the US government announced one of its programs to help the commercial paper market, and so the spreads started coming down. A big drop in January, and I'm not 100% sure what that was fully attributed to, since that was across all markets, non-financials as well as financials. But again, spreads look fairly narrow. That's the good news. The bad news is the market's a lot smaller than it was a year or two ago. So just in terms of dollars outstanding, we went from around $2.2 trillion of commercial paper outstanding, a very liquid, large market, to a big drop starting in 2007, crashed in September and October of last year, and then the government came in right around that time and started supporting the market, and so there was a lot of new issues at that point. But starting, again, that has dropped, so it's now roughly half the size that it was a couple of years ago. So just in terms of outstanding and how much money's involved here, that market has shrunk quite a bit. Okay, so there's some good news and some bad news. Other markets that were affected by this, so this is the interbank lending market. One of the popular measures of this that sort of entered popular terminology last year was the TED spread, comparing what large banks in London would lend to each other at for 3 months versus, again, the 3-month Treasury bill rate, so comparing it to what the US government could borrow at. And again, you see starting in 2007 and then quite dramatically in September and October of last year, quite dramatically, those spreads became very, very large. So you're talking about 4%, on an annualized basis between what a large bank in London could borrow at and what the US government could borrow at. So that, again, the good news is that has narrowed quite considerably. I believe this is somewhere around 25 basis points today, which is much closer, as you can see, to where we were prior to the recession, so prior to 2007. Longer term bonds, so the big concern was that this crisis especially in the short-term paper markets, lending markets, would feed into the rest of the economy. And so the concern was that was going to dampen borrowing in lots of other sectors. So not just from financial organizations, but also just corporations in general. And so you see here, comparing it to the 5-year Treasury rate, that started to come down again in 2007, dropped quite dramatically when investors seemed to flee to US government bonds in September and October of last year. At the same time, the spreads that corporations could borrow at, the interest rates they could borrow at, went up quite dramatically. Again, the good news is that went up, it's come back down considerably. If you look at just the raw interest rates, you see here, you're talking about interest rates that are around 5–6% for these different bonds, where they were a couple of years ago. Okay, so on an absolute level, borrowing rates really aren't that high today. Again, that's the good news for going forward. If you look at spreads, the fact that government bonds interest rates have come down so dramatically, other ones have went up or stayed fairly flat, means that, again, corporate borrowers can borrow at rates that are, in this case, quite a bit higher than comparable government bonds. So in terms of raw interest rates, the rates aren't that high. In terms of spreads above treasuries, the spreads look fairly large. Okay, and so that's a little bit of bad news, but again, more where we were at the beginning of 2008, towards the beginning of the recession, not where we were in October of last year when the credit crisis really started hitting pretty dramatically. In terms of the stock market, so a lot of what I look at is stock markets. A lot of those concerns fed into the stock market. Again, you can see volatility. So these are absolute percentage daily changes in the S&P 500 on a 20-day rolling basis. So just how much is the S&P 500 bouncing around day to day. Volatility started going up in 2007. Again, huge dramatic increase September and October of last year, and that has come way down as well. So over the last couple of months, the volatility in the stock market is, again, about where you would have been towards the beginning of the recession, if not a little bit lower. So in terms of just raw stock market volatility, we've really seen a dramatic change in how quickly volatility has come down. This is a longer-term perspective on that same question of how volatile is the stock market. So what I showed before was just a little piece of this graph, just a longer-term perspective here. Said we saw a dramatic increase. Compared to the prior 5 or 10 years, that was very, very dramatic and unprecedented. Compared to the longer term, the volatility we saw starting last year was high, but not unprecedented. Certainly if you continue this back to the 30s, you would see lots of time periods when volatility was higher than it was last year. But again, you can see it's come down and is pretty similar now to where it was through most of the 90s and some other points in time. So US stock market volatility really isn't all that high at the moment. In terms of just raw stock price performance, when I've talked about this in the past, I've often compared what we saw last year to the two prior crashes that would come to mind, so the October of '29 and the October of '87 crashes. And the real question was, which one of these paths were we going to follow? So were we going to look like '87, where it dropped and essentially started its march back up quite rapidly, quite dramatically? Or were we going to look at October of '29, where it came down and that was just the start of problems that were going to last for more than 10 years into the future? If you compare that to what we've seen over the last few years, so aligning the dates so that the crashes occur at about the same time, you can see what we saw was a more rapid, larger drop in, starting again, I think these are weeks, so you're starting in about early of 2008. The drop, I think we're talking about somewhere around 55 or 60% drop. That was larger than around either of those other two crashes. And at the moment, we've come back up a lot. So since it's low, we're up about 50, 55%. So again, that's the good news, looking more like, hopefully, the green line than the blue line. So the concern is obviously if you look at the stock market during the 1930s, there were lots of times when it went up pretty dramatically for 6 months or a year, and then reversed itself over the subsequent couple of years. So looking at this, it's a little bit hard to tell which one of these is more comparable. I've decided a better comparison, rather than looking at prior stock market crashes, is actually looking at stock price performance, stock market performance in prior recessions. So the ones that I think are most comparable in recent decades to the current recession is the recession of 1973 and the recession of 1981. Okay, those were about the same magnitude of recession if you look at GDP changes, effects on unemployment, and things like that. Compared to that, again, the stock market drop we saw was at its low, was more dramatic than either of those two recessions. So stock prices did seem to come down more. If you wanted to have a hopeful message, to the extent that those recessions are comparable going forward, then after both of those recessions, stock prices actually bounced back pretty well over the subsequent few years. And so I think, if I had to compare it to the crashes, I'm not sure are comparable. I don't think we're really comparable to the Depression. I don't think we're comparable to no recession of '87. I think those are probably better points of comparison, and I think that gives you a little bit of a hopeful sign that we've probably reached the bottom. But again, that's there's a lot of guesswork in that.
Thanks, John. I love those three slides are great. And I think I put you a little bit more on the optimistic side of things. Is that? Next is going to be Dave Morse, I think probably with a bit of a Wall Street perspective.
Terrific, great. Thanks, Bob. As Bob mentioned in introducing me, I've spent virtually my entire career in the private equity world. So when I talk about the credit markets and the credit crisis, it's generally from the perspective of leveraged loans and the high yield market. So my lens as I look at the credit markets and the credit crisis is through the private equity LBO world, similar to Sue looked at her world through the mortgage markets and the credit markets through the mortgage markets. And I do have to say, Sue, I was interested in your comments about the trends of disclosure and documentation in mortgages, because I think the only CD I got with my mortgage was Captain and Tennille's Greatest Hits. So focusing on the last year and the credit crisis in terms of the private equity world. When Bob asked me to be on the panel, I reflected on another panel I was on in Chicago in the summer of 2007 in front of institutional investors who would invest in private equity funds like the one that I'm part of. And I was asked to comment on a comment that was made by Steve Schwarzman, who is the CEO of Blackstone. And if you remember at that time, he said, we are in the golden era of private equity. And I was asked to comment on that. And I will say, in the summer of 2007, I felt that we were absolutely at a bubble in the market. It felt very peaky, and it felt like a bubble. We had record numbers of public to private, record premiums paid to the underlying public securities in those public to privates. Peak leverage was being used in those transactions. Purchases were being made off peak earnings and on peak multiples. So I thought at the time that something had to give. And the best recollection I could have at the time was around First Boston and the Ohio mattress transaction, if you remember that. So I retold the story of how First Boston bridged a $450 million loan to Ohio Mattress. That bridge got hung, and that drove First Boston into the arms of Credit Suisse. So I told that story, and I was going to talk about what I thought was going to blow this bubble up that we were sitting in. I definitively didn't believe it was the golden era of private equity. It turns out here, 2 years later, that no surprise, I was completely wrong about what would blow that bubble up. I argued at the time that we were in a really scary era for the banks and the investment banks. The financing of LBOs and the risk that the banks were taking on their balance sheets was far in excess of anything that First Boston did around bridging the Ohio mattress deal. And where I started to get it wrong was around here. In this era, this 2006, 2007 era, if you were a bank or an investment bank and you were looking to get the mandate on an LBO, you weren't just expected to bridge the high yield markets. You were expected to provide what we were calling a stapled financing at the time. So if you wanted the M&A assignments, such as you could get the juicy M&A fees, you had to show up with the staple financing, which was you underwrote, spoke to, committed to all of the layers of the capital structure in a given deal. Senior debt all the way through the subordinated debt, fully underwritten either yourself or with a small consortium. What scared me at the time in the summer of 2007 is that particular trend took a worse turn, which was sponsors, general partners, private equity firms were going to the banks and investment banks and saying, if you want this mandate, if you want this deal, not only do you have to give me a stapled financing around it so I have certainty of financing, you're going to need to bridge the equity in these transactions. You're going to need to put $200, $300, $500 million in equity side by side with me as a private equity firm in order to get this deal done. And what people forget in the First Boston situation is in that bridge loan that they made for that Ohio mattress deal, they had all these traps and triggers and acceleration rights that said if that bridge continued to be hung, they could go to the sponsor in Ohio mattress and claw back all kinds of rights and force liquidity. The way these equity bridges were working at the time in 2007 is the sponsors were saying you're going to take $400 million of this equity on your balance sheet. There will be no traps, no triggers, no acceleration rights. We'll tell you when you sell this equity off. We'll tell you to whom you sell it off, at what price you sell it off. And by the way, if you don't sell it off, you own it. You're my partner going forward in perpetuity on this particular deal. So what I kind of postulated at the time, again in 2007, was I thought that some bank would get hung with a giant equity bridge, similar to the way that First Boston got hung with the Ohio mattress bridge. But of course, the equity bridge is much worse. It's a true tier 3 asset. Takes primary capital against it and completely illiquid. So I was positing that one of these hung equity bridges would blow up one of these deals. And these banks were in a far worse position than First Boston was with Ohio mattress. So then, of course, what happens, what blows up this bubble is a complete meltdown in the senior secured debt markets. The highest, safest, securest part of the capital structure is the one that blew up, the one that historically was the easiest to underwrite and the easiest to sell on into the market. Had you asked me at the time for a trade I would have done, I would have said, short the mezz, short the high yield, short anything unsecured, go long the senior. Fortunately, I'm not a trader, because had I suggested that, I would have lost yours, every penny of mine and yours. And the reason I tell this story is that in the summer of 2007, I honestly believed it wasn't the golden era of private equity. I honestly saw a nasty bubble in this particular market. And as a 20-plus year direct participant in that market, I'm still amazed at how wrong I got it in terms of what would burst that bubble. It appeared in September and October of 2008 that all assumptions were no assumption was valid. So for me, what the credit crisis meant again was a complete breakdown of the senior secured and the leveraged loan markets. And therefore, in the slides that I promise I'll get to, my comments focus on whether a year later I think those markets, particularly the leveraged loan markets and the high yield markets, are back. This slide shows the average bid side of the market for senior secured leveraged loans going back to roughly 2001. What the chart shows, no surprise, is in September 2008, the bid side of the market just disappeared. It just went completely away. There was no liquidity in this market at all. What this implies is, of course, if there's no bid side of the market in the existing seasoned credits that are out there, there clearly is no new issuance or par market for leveraged loans. So the new issuance market went to zero during this period, and in fact, the secondary market in leveraged loans looked like a bottomless pit. There's another particular kind of trail of tears on this slide, and that is in the summer and fall of 2007, a huge number of distressed funds were put together to go out and buy this paper in the secondary market. Come January and February of 2008, these prices had reached the historic lows, which were effectively the 2002 level of pricing that you see on this particular page. The prices had reached historic lows, and the funds had bought heavily into this market at the time. And this strategy in 2002 was a huge moneymaker. You had a tremendous current yield, and then you rode the paper up to par, which was ultimately refinanced in whatever the next deal was around that subject company. The problem in this vintage of these funds is they levered. So Lehman blows up in September. The funds that had gotten raised got a margin call. The lenders took over the loans and dumped them into this market, creating an even more vicious cycle in downward pricing than you might have seen just organically on what was going on in the overall credit markets. And sitting here today, I can think of a half dozen distressed funds who pursued this scheme in the summer of 2007 and didn't have their first anniversary. So this was truly a bloodbath and drove these markets down. The good news today is those funds are all gone. That noise is out of the market. The loans aren't being dumped. Credits are firming up. At a minimum, the credits are more seasoned, so it's more attractive for secondary buyers, and the capital's coming back into this market. Having said that, the loans need to trade up further from here before I see a robust new issue market, because obviously a rational investor who has capital for this asset class is going to look to this market first before they look to the par or near par new issuance market. So some good signs here in terms of coming back. We're not all the way there yet on leveraged loans. In terms of, it's a bit of a similar story when we talk about the high yield market. September 2008, everyone took to the mattresses. There's no liquidity in this market at all. You see historic spread reaching 1,800 basis points in September, October of 2008. Kind of the saying now is with Armageddon off the table, the buyers are back in the market. We see today, as we sit here today, the secondary market and high yields come back much closer to historical levels, and what that means is the new issue market is back. So this market didn't get as crazy as the senior markets. You didn't have the pricing got tight. You can see it's 200 basis points above the treasuries in 06 and 07. The pricing got tight, but the structuring didn't get crazy the way that it did in the senior markets. No PIK toggles and no other crazy terms. And importantly, the high yield market is far less dependent on the structured vehicles, the CLOs, the CDOs, than the leveraged loan market or the senior loan markets are. So kind of, for me anyway, the unequivocal good news as we sit here today is the high yield market is back open and the capital is available. So the historic spreads are back, and the new issues are definitively back. Having said that, default rates are still at historic highs. People expect them to go higher. It's still very much, this is again the high yield market, still very much a buyer beware market. Credit analysis is critical, but again, the high yield market feels like it's firming, and that the liquidity is back in that market again. Going back to the leveraged loan market, what I have here is institutional repayments, and what you can see is in the last half, or perhaps the last 3 quarters of 2008, voluntary prepayments declined significantly, if didn't go to zero. We saw a trend of companies drawing down their revolvers fully during this period for fear that revolver would be pulled by the underlying lender. And we even saw some firms suspending mandatory payments, all, of course, in the pursuit of retaining liquidity in what was an unprecedented downturn. It appears now in the first half of 2009 that these loan repayments have picked up, whether they're voluntary prepayments or mandatory payments. They're coming back. That feels good. There's more liquidity in terms of these loans being paid back. If we continue kind of with this idea to the next slide, This shows the number of amendments that have happened in the first 2 quarters in terms of covenant relief. This, again, to me is another important and optimistic trend. The lenders and the borrowers are being very proactive in restructuring their loans and are largely avoiding bankruptcy and foreclosure. This is not the banks being generous or the lenders being generous. This is simply being pragmatic. There's an old saying that you can call your loan, but that doesn't mean it comes running. And that's exactly what's going on here. Lenders and borrowers are negotiating for time. So the idea is get covenant relief. There's a concept of amend to extend, which is amend a loan to extend its maturity, to buy your time to get through to the other side of this downturn. From a private equity perspective, these types of restructurings generally involve a new round of private equity. Additional equity is coming in under these loans in order to get these extensions, in order to get these covenant reliefs. And interesting in this market is compared to the early 80s, the late 80s, the early 90s, and the 2000s, if there's a subsequent round of equity today in a private equity deal that's being done to affect one of these types of restructurings, it's the biggest pay-to-play market I've ever seen in my career. It used to be that if you were an initial investor in a deal and there was a secondary round, call it a rescue round, you retain some level of ownership and economic upside in that company for having been an original investor. In this market today, if you don't play in the subsequent round, you're getting absolutely zeroed in your original equity. It's a severe pay-to-play market out there today, and the folks that don't have add-on capital for these deals when these restructurings are being done are being left absolutely in the dust. But again, this is in the best interest of the lenders because clearly the lenders don't want to precipitate outright defaults in the market that we're dealing with. My last slide here is the one that keeps everyone up at night. We clearly had record issuances of loans and bonds in 05, 06, and 07, and those are maturing in 2012 through 2014. One of the reasons that borrowers and lenders are being so aggressive in these amend to extend types of deals and restructurings is to get past this maturity deadline that we're looking at here. In today's market, was in the paper just the other day, there's a $2 billion credit supporting Blackstone's purchase of the Anheuser-Busch theme parks. Apparently, according to those press reports, it took over 6 months for them to arrange that $2 billion of financing, even though there's $1 billion of cash equity sitting under that particular deal. So given that dynamic, it's kind of hard to imagine that there's going to be $379 billion of liquidity in the market in 2014 when these outstanding issues come up for maturity. So the good news in this, however, is that everyone I talk to, certainly in the private equity community, is this is the number one thing on their mind. They're trying to get ahead of it. The worst fear that they have is you've got a well-performing company that is doing what it is supposed to be doing, and then suddenly you lose the keys because you can't refinance it because it gets caught in the undertow of this massive volume of refinancings that's going on in 2014. So people are trying to be proactive. They're trying to stay on top of this. I guess in terms of conclusion from what I'm seeing, I think from my little window on the world, the high yield market is definitively open. It's back again. There's been a significant thawing in the pricing and the trading of outstanding existing leveraged loans in this market. However, the new issue leveraged loan market's not back yet. We still need to see some more firmness in that. The entire community is concerned about this particular wall of maturities, but in general, it feels to us like the worst of this is behind us, and the participants aren't being bashful. They're being very, very proactive in trying to address the continuing outstanding issues around this particular market.
Dave, thank you. Lots of heavy stuff for a Sunday morning, that's for sure. But I sense a reasonable amount of optimism on Dave's part as well. So that's 3 out of 4. Alec, are we going to?
Where does that leave me now?
Are we going to continue with it?
Good morning, everyone. I appreciate you staying here on a Sunday morning. I would rather be golfing, to be honest. And so the fact that you expect some smart words or words of wisdom puts us in a difficult position. I had originally thought that my colleagues would present the developed world kind of picture so that I could come with my Latin American perspective. Now that that's not quite the case, I would rather go very rapidly through to avoid the politicians' disease to answer different questions that they are being asked. You don't really care about what's going on in Latin America. You probably prefer to hear our views as to how this overall crisis will come out. I bet there's not even one guy that invests in Latin America here, so why should I give you so many details? But you have to go through some learning process at least to understand that these Latin American countries are such that Brazil has become a continent. Everybody should know that. Brazil has received from the US the legacy of handling the politics and crisis of Latin America. The US does no longer want to get involved in our part of the world for very good reasons. They have enough problems around the rest of the world. So now Brazil is our big imperial power in Latin America. Brazil being half of everything else in Latin America. Mexico being second, and then all the rest, our countries, Argentina, Venezuela, Colombia, Peru, will comprise about 25 to 30% of GDP and everything else. But leaving aside population numbers and GDP numbers, look at this one. Foreign direct investment from $80 billion total in last year. Brazil received more than half. Everybody looks at Brazil, everybody likes to go to Brazil, everybody's asking about Brazil. Unfortunately, Mexico, which used to be the country that should have followed, is suffering so much from the US crisis that it's not receiving its fair share of investment. It's probably suffering much more than anybody would have expected. Let's go through quickly to point only two things. As you know, as you have seen in this country as well, the markets react normally 2 quarters, if not even faster than the real economy. So what we are seeing now is not a recovery of the real economy. We are seeing a recovery in the markets, and we are market people, so we all love it. Yet the politicians normally don't look at the markets as much as they look at the real economy. So we will have, there are some implications there that I would like to point out later. The second is, in this page, is spreads and interest rates. LATAM has tightened substantially. We, in the worst part of the flight to quality, typically everybody went to US Treasuries, and Latin America suffered, despite the fact that from a credit standpoint, if people had done their numbers, they would have realized 2 very important things. First, that this crisis is the mother of all crises, at least in our time spans or the history we know. We don't go back more than 2 centuries, right? So the 29 crisis had been the crisis, and everything is compared to that. And this crisis was nurtured, fueled, and developed in the, quote, developed world, right? US, Western Europe, Asia a little bit less. We in Latin America, not that we were not connected, but first of all, we had much less leverage around the economy. Really, there was very little leverage, to say the least. Very little liquidity, second, and much less sophistication. When you see what my fellow bankers did around the world to sell derivatives, CDSs, and all sorts of crazy products, including your packages of mortgages, they went as far as Mexico. They wouldn't go any further down. The Brazilian banks are today, if you can believe it, larger than many huge, traditionally largest American banks. The Brazilian banks today are incredibly powerful, for no other reason that they virtually suffered nothing from the crisis. So this is just to show you, as everything else, the credit market went all the way up in terms of interest rates, and now it's back to, you see Mexico, Chile, Peru, and Brazil here, back to pre-crisis levels already. So there's nothing to worry there. The credit default swaps are a very good index for that. This is the equity situation, the same thing in Brazil, Colombia, Chile, and Mexico, all coming back to 70% levels of the peak. So with the only exception of Brazil that was really booming in 2007, things are coming back very rapidly. Foreign exchange, all currencies are appreciating against the dollar. We are worried because I don't believe Mexico or Chile or Colombia are better than before. Maybe it's the US that is worse than before. because everybody measures against the dollar. So these currencies are improving vis-a-vis the dollar. And you see the index here was 100, and now they are all back to the, or close to the pre-crisis levels. But we'll talk about that in a minute. Everybody worries about inflation. The only country that really has a problem is my own country. Unfortunately, we have a tremendous history, and the only one whose currency and inflation is not totally, but quite out of control. The rest are pretty good. Just so that you keep in mind the status of Latin America these days, you have four countries, Brazil, Chile, Mexico, and Peru, who are investment grade, that are doing their homework. They have become disciplined, they have become orderly, and they are deriving a lot of benefits from that. Colombia is probably coming into it very soon. Tiny Uruguay up running and becoming investment grade also very soon. They hope it's even before the end of the year. And then what I have generously called the laggards, it's believe me, it's not very pleasant, and I'm not very proud to have to admit that Argentina can be compared to Venezuela, and Ecuador, and Bolivia, but that's what it is. This is what politics do to countries. So we'll be delighted to talk to whoever wants to talk about that later on. But bottom line, market indicators are powerful arguments in favor of those that believe that the crisis is over. Those markets are coming back. The normalization phase is close to being complete now. As I have stated above, macroeconomic indicators trail a few steps behind financial ones. So where does that lead us? I just put the last graph. You don't want to see all that. Growth, no, because if it was a Latin American presentation, I would bother you with the details, but this is what you should look at. The worst decrease in GDP, you can see, was Mexico, 7% compared to most of the other countries that suffered relatively much less. But IMF projections and most consensuses go for this kind of rates of growth in 2010. So you can see that Latin America suffered less and it's probably coming back faster. But this is not fantastic news. It just speaks that we never had credit, so we're not suffering from a credit crisis. But I'd like to say something about where we are going, because history we all know and we all receive research reports. But going forward, I'd like to make just a few comments. I think the lessons we have learned from this crisis for the first time, I think is very reassuring, is that central banks around the world and treasuries around the world reacted incredibly fast and incredibly well, surprisingly well for most people's expectations, because we have different tools. People have learned their economic lessons in business schools, in economic schools, wherever, and we have witnessed central banks using all the fantastic weapons and elements they had to flood the market with liquidity when demand for money was there. So despite Lehman, I think we have avoided a much substantial harm by the quick and powerful reaction of central banks and treasuries. Now, second aspect of that is that for the first time also, there was a much larger degree of coordination. The Europeans pretended to fight, pretended to be, not to follow the Americans as they should, but finally they came around and they coordinated quite well, and we have seen that fast and coordinated reaction. I think the question comes now, when that demand for money recedes, when we go over, as we believe we have gone over the hump or the valley and coming back into growth, will the politicians accept what the central bankers will recommend? I think that's the trillion-dollar question, because fortunately Mr. Bernanke's ratification comes before he needs to start tightening. But if and when he needs to say, okay, the demand for money is no longer there, the crisis is over. We have to start absorbing. We have to put the pump in reverse. We have been flooding, now we have to take the water out. Nobody's talking about that. And that is a $1 trillion question, because if that doesn't happen fast enough, if it's not strict enough, if it's not disciplined enough, then we will see, as some people are already worrying, tremendous amount of inflation. Will the US be tempted to inflate itself out of debt? You will end up this process with massive amounts of debt, trillions of dollars of debt, and government deficit that has to be financed and has to be paid. Now, the temptation, you know, and I'm telling you, I know this because I'm coming from chairing a central bank in a country that did not have the privilege of printing dollars. You know, we're printing pesos and nobody cared for pesos, so we really couldn't do anything. But when you're printing dollars and people seem to like dollars, then you know, the temptation is very great. And to the extent that the Chinese and the Russians and everybody else were absorbing those Treasury bonds, then you can continue printing. The question is whether there is a limit to that, and whether the US central bank first, you know, the Fed and the Treasury and the government and the US people, you, my friends, will have to face the fact that somebody has to pay the bill. There are regular consequences there. So why I say this? Because I think the markets have come back, but suddenly we say, okay, the crisis is over. So we start putting the pump in reverse. No, wait, because the real economy is not over. Unemployment is still there, and level of activity is not what it should be. So let's leave it on for a while more. Then the politicians have never, in the past, at least in the countries I know, the politicians have never allowed the central bankers to be as independent as they were when they were pumping the money in. Okay? Because the politicians love to see the money coming in. They don't like to hear Mr. Bernanke say, hey, you know what, we have to start raising interest rates. That's not politically very good. That's a big question mark. Sorry to leave it open. The second big question mark is regulatory consequences. I believe that it's very difficult, and we have suffered in our own countries, to hear people say, yes, we're in a capitalistic mode, in a capitalistic world, in a capitalistic economy. So earnings are for the shareholders and for the executives. Bonuses and dividends, everybody happy. Now, what about losses? Oh, no, losses are for the taxpayers. No, it doesn't quite work that well. Politicians don't like it. They don't know the responses. All they know is that in the moment of crisis, somebody comes and says, hey guys, you know what? If you don't save Lehman, if you don't save the rest of the system, the losses are going to be much worse. So they understand that and they let the money come in. But when the time comes to say, okay, now we go back to bonuses and happy-go-lucky shareholders, it's a different world, okay? So with those two questions, unfortunately, unanswered, I would thank you very much for your time, and we'd like to go to
Thank you, Alec.
questions.
I was going to ask each one of the panelists about the major risks, but I think they've kind of covered it. I think Sue is a kind of a return to the behavior that got us into the crisis in the first place. John, I'm not sure exactly. I think it's just kind of the ephemeral risk of returning to some of the previous crashes instead of continuing on the path. With Dave, it's the refinancing risk.
And I would add commercial real estate.
And nobody's mentioned commercial real estate, so that's a good one. And Alec, I think the two ones that have been on a lot of people's minds is how do you withdraw this liquidity, and also the regulatory risks. On government policy, since the fall of Lehman Brothers, I don't want to tarnish the grading with that one. Alec, what do you give government policy? Our grading scale, remember, is H for honors, S plus, S, LP,
For letting Lehman go down?
No, since Lehman.
Oh, since Lehman, I give, if not an H, the one coming right after.
S plus.
S plus, yeah.
Right. As a Stell scholar, I don't think I'm a great grader, but I would say Bernanke in particular, you've got to give him an A, because he opened his kit bag in a way that no one, I certainly wasn't even aware that he could do, and I think he was the right guy in the right place at the right time.
That's an honors, John.
That's an honors.
I'll go with the prior two, an H for the central bank and S plus overall.
Sue?
Yeah, I would say S plus as well. Maybe not for the reasons they put those policies in place, but the results have been.
All right, well, follow this optimism onto my grading this afternoon, and the first years will benefit from it. So the panel's open to some questions, so if you want, just say your name if you can, and speak loudly, because the one thing about this room is you have to speak loudly for the person over here to hear you.
My name is Matthew Murray, and I'm the husband of a graduate. I was actually wondering if we could go back to the Case-Shiller graph. I had a question on that. Is that possible?
I might be able to. What's your question?
Well, I wanted to challenge what I understand to be Sue's explanation of the sort of the behavioral or the, how individuals are lying on their mortgages or embellishing their credit rating. It seems to me that sort of behavior is a human behavior that's been going on a long time, and I'm wondering if maybe there's some other explanation for why you have this huge discontinuity to what looks like a trend line that goes back, I would assume, even before 1987, where real estate's going up 3 to 4% a year. I mean, Alan Greenspan has one hypothesis about how the far end of the yield curve went up in foreign fund flows. Is there anything beyond, it just doesn't seem to me that people started lying on their mortgages in 2000.
So what caused this tremendous increase in asset prices generally, but particularly housing prices?
Right, I think housing prices did get run up and inflated, and we saw appraisal fraud starting in about 1997, 1998, and if you could get an inflated price for your home, you could get a loan to purchase the home, a bigger loan. So I don't mean to suggest that everybody started lying and that is what brought this crisis down, but I do think that real estate prices got inflated and consumerism got excited and moved these things forward when they shouldn't have. And investors got caught up in it and were willing to pay for it.
Dave, do you have any ideas on the fundamental forces that caused this thing to happen?
It was a giant, in all the securitization markets, it was a giant game of musical chairs. It was, originate, package, sell, and be left holding no residual interest in the paper itself. So it's again, it's buyer beware. So you had this great factory to generate fees and pass the risk on to someone else, and human behavior just cranked that up.
One of my colleagues said that we won't have the Nobel Prize in economics this year given to a finance person because of what finance did to the world. John, any finance theory explanations for this that you wanted to?
I guess if I was looking at that, I think starting about 10 years ago, there was some institutional, the expansion of the securitization market, I think certainly accelerated then, as well as government push to expand home ownership. And there's at least some sense of which that might have been to blame for some of what we saw. I mean, if you look at home ownership rates, in the U.S., they also started increasing, I think, fairly dramatically around that same time.
I was interested that Dave mentioned the commercial real estate market because I'm a lot more pessimistic because of that. I mean, if there's 379,
you're going to spoil our 4-4 record here on optimism?
I mean, the numbers may look great, but I think everybody's ignoring this huge overhang in commercial real estate. There may be $379 billion of high yield and leverage loans coming due in 2014, but there's $1 trillion of commercial real estate refi next year. And nobody's really talking about that. And that combined with what I think is really an artificial market. The government is still behind so much of the market, the mortgage market, the CP market. How can we really say we have a truly operational capital market? And when there's so much overhang to refinance in the artificial market.
So Dave, is commercial the next shoe to drop, or has it been fully anticipated and people are prepared for it?
Yeah, I think it's the next shoe to drop. I think the refinancing is exactly right on. You're continuing to see rents and occupancies, fall off the face of the earth. I have, no idea, what exposures are, across the various institutions and what they've done to prepare for it. But yeah, I think that is the big caveat. That could be another round of, blowing up the bank's capital again.
As a regular person, how will I or anybody else feel when they try to take the liquidity out of the market, when Bernanke reverses himself? What will it feel like?
Alec, what's the pain going to be like?
They start selling bonds rather than buying bonds rather than selling bonds. Tightening the rates. You will see the interest rate go up. They will say, see, from an outsider, and I know there are political implications to what I say, but what is TARP? How could the government approve an $800 billion program in, what was it, 20 days?
Pretty much.
You know how hard it is to spend money? I mean, it takes years to get the programs to really spend what Congress has approved. I believe if you ask the real questions, we are all great looking at the markets, but I don't believe TARP has been taking care of more than 30% of what a total program is, right?
They spent probably about $300 billion, I think, has been spent.
I think it's, or a little bit more. So what I'm saying is, it takes a lot of government spend, what the Democratic Party did apparently was to take all the programs they had in their political agenda for years and said, let's approve all of this. So suddenly we have housing and colleges and Medicare, whatever, all the programs, social programs, but they have not been able to implement that. So you didn't get the benefit of all that program yet. But what you had was a tremendous influx of money to solve the financial system and to help for monetary demand. But when people no longer need the dollars, when people start saying, okay, I don't want to have dollars anymore, somebody has to absorb them. Otherwise, the response is inflation. And very few people, you probably remember the good Carter years at 16 and 18% inflation. Well, this is what you go into much more rapidly and much higher with the present situation if you don't do very.
Are you telling me that to take the liquidity out, we're going to have to suffer a whole lot more unemployment than the nation?
Well, this is why I mentioned that the politicians will not like to see that request from the central bank or that action from the central bank. I'm only saying that the alternative is even less pleasant. Yes, what I'm saying is that if you want to pay back your debt in decent terms meaning in not 55 years, but perhaps 15 or 20, people here will have to tighten their belts and start saving more. This is what that's what the rest of the world does when they have to pay the debt. This is why I said, we never had the benefit of the dollar printing machine, and you do. But then that's the other alternative, to print yourself, inflate out of debt.
Mr. Downs.
I'd be interested in panelist observations on China, the roles China has played and is going to play in the near future on solving some of these issues.
Alec, you want to?
I always have an opinion, but it's not necessarily.
If there's an inflation, China's going to feel it pretty.
They are saving much more than anybody else, and of course they have been carrying the surpluses and buying your debt. But they came a point last year. They said we may not want more U.S. denominated dollar bonds. Why don't you start issuing treasuries denominated in yen or much less renminbi, whatever? Imagine that. What are the political consequences of that? I don't have an answer.
Yeah, that would have been my reaction too. Is as the buyer of dollars, when do they want to stop, and does this ramp up further talk about an alternative reserve currency? Just the sheer amount of our treasuries that they're buying just truly scares me.
It's mind-boggling.
Let's take one more question and then we'll break. And I'm sure we can get these guys to stay with us for a little bit longer if we can. Yeah.
Jacobson, does the U.S. have the ability to fight another crisis if we had another Lehman Brothers collapse next month, or are we bankrupt?
Can we fight if if the commercial bank loans on cities' balance sheet go bad and we have a run of sorts on
You
city?
stop the run the way runs are stopped. By not doing that in 29, you had to close hundreds of banks and make the crisis much worse. The only way, this is all about trust, okay? So when trust on banks fail or people start taking their money away, the only response is to pay back those deposits as fast as you possibly can by flooding the market and letting everybody know that you are not going to allow banks to fail. It's the only, that's where, I don't know what Dick Bauer will think or many other economists here. Really, nobody knows any other better way to stop a bank run, because the world is not prepared to understand, the common citizen is not prepared to understand that his money is not waiting at the cashier every day to be returned, that the bank has lent the money for 5 years, and that maybe only 5% of the deposits can be returned overnight. All the rest may have to wait 1, 2, 3, 4, 5 years. So what? Central bank pumps the liquidity. That's great. Now, once the crisis is over, I had that problem in 1980. Okay, I was chairman of the Central Bank of Argentina, and we had to print the hell out of money, and to cover it, we had to close 60 banks. And the way it ended up, the government was overthrown, okay, 5 years later, because inflation was rampant, because the country could not pay for the consequences of having solved the financial crisis. So it's in every book. It's just that the American people don't like to read other countries' books, particularly when it comes to this kind of crisis.
A great thing to look at to see the impact of this crisis is look at the balance sheet of the Federal Reserve of the United States. It's up to $2 trillion from, I think, probably $750 billion or something some time ago. There's $750 billion in mortgage-backed securities on the balance sheet of the Federal Reserve. That's what they've done to get us out of this crisis. And there's no limit to how big, no.
Now, let me also say,
there's some practical limits in terms of inflation risk down the road, but if they need to do more of this, there's nothing to stop them from doing what Alex is talking about.
I would like to end on the note that most international economists of great experience that I consult and that we read believe that the treasuries of this world and the central banks of this world will apply what they know they should do, and the politicians will have to allow them to do it because crises are much worse. But that may do away with many politicians then. With many, we will see a lot of political and many elections going in the unexpected way because people don't like to pay for the prices of yesterday's party, somebody else's party particularly.
Let's have a round of applause for our panel.